Now, coming up is something that I'm very interested in because I've been hearing about Series A crunches in 2014 and 2016 and 2019, and it seems to be one of those venture rounds that is just very hard to nail down. So what we've done is we've got a couple of VCs and my dear friend Tim, and they're going to break down what people need today to raise that Series A. So please welcome to the stage TechCrunch's Tim Deschamps. We also have Maren from January Ventures, James from NFX, and Loren from Bowery.
All right, thank you, Alex, and thanks everyone for being here. Now, it's no question that the Series A is still a major milestone for startups. But what founders need to hit has become increasingly murky. It seems like the goalposts have been moving a lot lately. And Loren, we'll start with you. Why is that?
Sorry, I couldn't quite hear your question.
Yeah, no worries. So with the goalposts have been moving for Series A's lately. Why is that?
I think there's a variety of factors that are going into the change in what a Series A fund is looking for today. I think, let's say, as compared to maybe 2021 times, just because that was a time when cash was flush, everybody was getting marked up. Founders sort of felt like there was endless access to capital in the markets. The market has changed dramatically. Started in the public markets, being down, software multiples were down in some cases by like 80 or 90%. And then it slowly trickled down to the growth stage, to the Series Bs, to the As, and to the seeds. And as part of that impact, a lot of the Series A investors are understandably, looking for a higher bar. They are trying to anticipate, can the companies they invest in raise future rounds of capital? And so I think with that in mind, their bar is higher. Now, what does it mean? What are they actually looking for? I think we'll talk about that throughout this entire conversation. But some things that have just obviously changed are, I think there was a lot of, the bulk of seed stage companies were raising off of story, not traction. Successfully. I think there's been a real shift in focus towards traction, momentum, legitimate product market fit, and I'm sure can cover what that actually means in detail. But I think they're looking for fundamentally strong businesses that they can put money into and trust that that money is going to be spent efficiently.
Yeah. Maren and James, does that mirror your experience?
Yeah, I think what I'm seeing in my portfolio, so I focus on pre-seed, and so I'm seeing as companies mature to seed and Series A, I think a year and a half ago, if you were at $1 million or even approaching $1 million in revenue, the Series A would just come together in a snap, and that has changed really quickly, and we've been spending a lot of time with our companies just talking about how that has changed, and I think now it's probably more like 2 to 3 million in revenue we're seeing where those rounds just come together in a snap. So I think it's an unsettling time for founders because it feels like they were going for a goal, they hit the goal, and then everyone tells them that's not enough. Go back, do more. And so I think we're seeing a lot more bridge rounds. The latest Carta data showed that 40% of seed rounds are extension rounds. Because I think it's just that continual, like you need a little bit more and go back and get a little more capital and try to hit those goals.
Yeah, what we've noticed in the statistics is that I think the Series A deployment is down 60% over the last year and a half. The amount deployed per Series A is down about 25% from 10 million to 7.5. And the number of deals getting done is much fewer. And so we're seeing huge compression, interest rates go up, deployment goes down, and then we get what we get. That's why we are where we are. Look, we just ended the 13-year bull run, unprecedented. So the goalposts have changed because the goalposts were unreasonable for a time. What we're seeing is a return to normalcy.
Right. Now, Maren, you've seen a lot of founders at the pre-seed and seed you mentioned at your firm. How has the lack of certainty really affected them?
The lack of certainty. I think it's hard because I think before people felt like they kind of had a goal that they had to hit, and now it's a lot more uncertain what that goal is. And I think there's a lot more of that sort of like magic that goes into what makes a fundraise now. It's sort of this combination of certain markets, certain industries, Certain stories seem to resonate, but it's not as straightforward as it was, where it was, I think, a year and a half ago, you could sort of raise more just on metrics. So there's a lot more kind of coaching that I find is going into rounds, and we're telling founders just start earlier and expect to have a lot more meetings in the top of the funnel in order to get your round done.
What kinds of markets and sectors are you seeing that work in?
Yeah, well, I'm sure nobody would be surprised. AI is an area where we're seeing rounds get done quickly. We're also seeing a lot of climate. Those are probably the two biggest.
Yeah. And cybersecurity for us. Sorry.
Well, I was going to say the uncertainty is fantastic for founders because I think that we're at this point now where everyone thought it was paint by numbers. In fact, I think we brought this up when we were talking earlier.
Yeah.
I kind of questioned this whole panel. Like, what do VCs need to see for a Series A? Screw the VCs. Like, build your business. If you just build your business, they will flock to you. 30 years ago, there was 150 GPs in the United States. There's now 31,000 on Signal.nfx, right? And we're running around looking for great deals. Stop thinking about what we want. Start thinking about what your customer wants and how to build your real business. And so I think at the end of that boom, that 13-year cycle, people were being taught that it was like a paint by numbers game, like it was high school or college. I do this, I get this grade. That's silly. That's not what real entrepreneurs do. We should be thinking uncertainty. We should be thinking, what do I need to do to build a business? So I would kind of throw that out, that we need a mindset shift, and this uncertainty is actually really positive for founders.
Yeah,
Part of it, though, is the industry maturing and the fact that now there's a lot more capital, there's a lot more of a playbook, and I have the same reaction to paint by numbers not feeling like what we want this industry to be, but I also think there is a game, and I think everybody should know the rules to that game so they have a fair shot at it. And so I think it is important to share what VCs see as the metrics and the rules and the benchmarks that make a good company.
Yeah, I guess to both of your points, when I'm coaching founders that I sit on the board of their companies, I do share what we typically see, right? There are benchmarks around where a Series A gets done, but I say there is not a magic bullet here to get there. It's about building a fundamentally strong, viable business and proving to your Series A investors that this can be a huge opportunity. It's not as simple as 2 million of revenue. There are companies that have 2 million of revenue that won't raise a Series A, right? And everyone hears about the anomalies getting done, but the reality is, if you've built a fundamentally strong business with great customers, strong cohorts, great lifetime value, happy people that are sticking with your business, investors want to back something like that. That seems like a long-term great opportunity for value creation for you and for them.
Yeah, now James, you alluded to something we mentioned in one of our earlier conversations, this growth in venture capital where you're seeing a lot more funds out there. I think you called it the startup industrial complex at the time. What do you mean by that? Like, how exactly is it affecting the Series A?
Yeah, so I call it the startup industrial complex because there's so much media, there's movies, there's TV shows, there's so many venture firms like our own publishing all the secrets. So all the secrets are now open, which is great for everybody's involvement in the system, but now the system's gotten really big with so many VCs and so many startups. And so the game becomes more and more of a game. It becomes more and more of a paint by numbers sort of thing. And so I think that's had the biggest impact. And I also think that it brings a lot of people into this industry. It's like, I want status, money, and power. Therefore, I'm going to go into tech, and I need to find an idea that will get me to that thing. And then I'm going to figure out, like I figured out college or high school, how to do it. And I just don't think that's where great companies come from. And so if you're a founder who's thinking that way, you've got to shift your mindset to be much more aggressive, much more live off the land, and so these Series A's, I think, are trying to suss out. Okay, NFX might have done the seed round, but is this company going to be massive? Are these founders real founders, or are they just playing a game?
Yeah.
Because they've chosen it as a career. I think 8% of the Harvard Business School went into venture capital last year. They took jobs in venture capital. It wasn't even a job 20 years ago. There was no such thing. It's not like almost 10% of the class at HBS. So it's kind of getting frothy. We got Shaq here. I mean, it's like, this never was the case. 20 years ago, everybody at these things was misshapen, and everyone smelled, and everyone was talking about numbers, and it was very different. So there's a lot of glamour now. It's just because of the money. The money has come in and addled everyone's brains. So.
Well, and some of that's got to be due to the maturity of the asset class, right? I mean, how much of that maturity is driving it? I mean, do you think it's a good thing, a bad thing?
Maybe the question is, do you want, instead of 8% becoming VCs, do you want them all to go become founders? Like, maybe it feels easier to be a VC than a founder now.
Yeah, I think it is easier to be a VC. I can tell you, it's easier to be a VC.
Has venture capital become too safe?
I think it's become like investment banking, right? 20 years ago.
Yeah.
Yeah, it's
But I shouldn't say that because we're all up here.
Well, no, there's a playbook for investment banking back in the 80s and 90s, and everybody wanted to do it. And now there's become a playbook for this too, and everyone wants to do it. I mean, LA Law was on TV in the 90s, and we had this huge bubble of lawyers coming through in the 90s. The same thing's happening with this. And so we just have to figure out, who's going to be able to go the distance. And so I don't know that everybody should be a VC, and I don't know that everybody should be a founder, but I do feel like everybody can find a place in the startup industrial complex where they'll be happy. Because you have to have a certain level of tenacity or negativity to be a VC. You have to have a certain level of, tenacity and craziness to be an entrepreneur. And many people are too reasonable. So they should go work for Facebook. They should go work for a Series B funded startup where they can play a role, and they could still make $10 or $20 million and have a lot of status and prestige and money, but they don't have to be a founding CEO or a VC in order to do that. It might not fit their personality, even though those seem like the high status things to do.
I think, part of this is the 13-year bull run. A lot of people made a lot of money in this industry, and that's attracted a lot of talent and also just a lot of interest in the space. I think there's going to be a real right sizing for a lot of funds and a lot of founders in the next 18 months, and there already has been, right? Valuations are not what they were. They're probably going to be taking a lot of down rounds over the next 6 to 9 months, and it's going to become a little less sexy than it's been for the last 15 years, and that might change things.
Yeah, our average valuation in 2017, I think, was 13 or 14, and then it went up to 19 during the bubble, and now it's back down to 11.
Wow.
So it's really, really changed.
Yeah. Is that mirror what the other?
It's very similar to ours, yes.
Yeah, I'm seeing.
That's at the seed level.
Yes.
Yeah.
I'm a seed, she's a seed, and she's a
yeah.
pre-seed.
Yeah. For pre-seed, it's lower, but the same trend.
Yeah.
And what are you seeing for Series A?
Same trend.
Same trend.
Same trend. What would have been done at 45 post a year and a half ago is now getting done at 26,
Yeah,
22.
30,
30.
maybe.
Yeah.
Yeah.
And they're smaller rounds, right? Like a 2021 Series A was $15, $20 million for the round size. And, it wasn't atypical for a $1 million ARR company, or average, recurring revenue business to be raising at a 50, 60 million pre-money valuation as like a median, right? I think like there were a bunch of anomalies that are raising in the hundreds off of sometimes less than $1 million of actual revenue.
And
But-
those are the companies that got in TechCrunch.
Yeah.
And so everyone reading it thinks that that's what's supposed to happen to
yeah,
them,
like,
and then
that's
they get
news.
disappointed.
Yeah.
And then somebody needs to explain to the founders, it's not going to happen to you this time.
I do it every time there's a fundraise.
Right.
They always hang on to the anomaly, and I totally understand it, but it's just, I don't think it's good for the founders. It's not good for the business, right? If you take on too much capital and you take it on at a valuation that's not sustainable, it will catch up to you. And like the down rounds are not friendly. A pure, clean down round is probably what most companies are hoping to do in the next 12 months because they all probably raised at a valuation that was too high. But in this market, that's a great deal. We're seeing a lot of highly structured deals now with things like liquidation preferences included in the rounds, or a common structure is like a pay-to-play round where all the existing investors need to put their money in, or else they're going to get brought down to be common shareholders, and you don't want to be, and there's a liquidation preference issue. And so we're seeing a lot of more structure, we're seeing a lot more down rounds, and it's going to continue to be the case because the times have changed.
On the point of Series A rounds getting smaller and being more like 10 million instead of 20 million, I was talking with a founder about this yesterday. I think I'm seeing more A2 rounds where they, with 10 million, aren't able to hit the metrics for a Series B. And so it feels like it's becoming a bit of this like, almost like dead zone where they kind of struggle at that point and need a second Series A, a second 10 million. I don't know if you guys are
It's
seeing.
happening at the seed too, right? Almost
Yeah,
every
for
seed
sure.
stage business is taking a seed and an extension because they're only raising $2 or $3 million, but they're expected to get to $2 million of recurring revenue for a Series A, supposedly.
Yeah.
Those numbers just don't work.
Yeah. Yeah. No, people are having to learn to be a lot more frugal and do it with a lot less people, and AI is helping with that, but it's not there yet. It will be in the next 24 months, but it's not there yet. And to the point, the three of us up here want your Series A's to be as high as possible. That makes us look good to our investors. That makes us feel like we're making progress with our investing. What we're saying is that when we're coaching the founders to realize that it's gotten worse, that's because we're on the ground floor, like co-founders with you, trying to work out how to move forward. It's not because we're trying to be evil VCs trying to suppress your valuations. We really want them to be very high from the highest quality investors possible. We're just saying that we're the ones who have to have the hard conversations with the founders, and that's been tough for the last 2 years, as everyone's had to adjust. And they're like, yeah, but James, I saw this thing at TechCrunch, and they raised at 60 million. I'm like, yeah, but that's not you. And they don't want to hear that. And then I have to have the hard conversation, and then they get mad, and it takes them like 8 weeks to get over it, and they're like, okay, I'm over that. I'm like, okay, but geez, man, it's a lot of hard work.
But then it makes the raise twice as long because they go out with that much higher number and then they can't hit it. They struggle. It's a
You
hard
burn a bunch
process.
of bridges.
Yeah.
with your
How many
best
people did that?
investors.
So many
Yeah.
people did that.
So it sounds like founders are in a tough spot, right? Because money was flowing freely even a year ago, maybe 2 years ago. And of course, you're going to take a good deal when you see it, and the terms weren't nearly as onerous as they might be now. How do you navigate that as a founder, and how do you prepare your founders for those conversations?
We've got a whole process. We've actually got a person on staff who's in charge of helping raise Series A, along with the GPs, and then we've got a person who does your deck, and we've got a person in PR, and we've got the whole thing sort of set up with a whole team and a whole process. One of the things we do is we have our founders, the week after we invest, we say, write a press release, or no, write the TechCrunch article. We literally say, write the TechCrunch article. The TechCrunch is going to write about your Series A once it gets done in 18 to 24 months. Who do you want investing? Why are they investing? Who are you winning? Who are your customers? So that they can visualize it. And then we say, build a deck. This is in the first week after we put in the seed. Build a deck that you're going to use to do your Series A's in 18 to 24 months. And what that does is it focuses them on the metrics, because it's moving the metrics that makes the Series A inevitable. The metrics are the reflection of the real business. And instead of them getting crazy and hiring a branding agency and getting an office and all this stuff that adds nothing to the metrics in the deck, we help them focus in on that so that they don't waste the next 6 or 8 months playing business. Because now they're like, oh, I'm in the big time, I raised my Series A, my Series Seed, I'm good to go. We try to help them focus in on that so that it actually just happens.
I don't think our coaching has changed. I just think I'm being heard a little bit better. I'm being taken a little bit more seriously with the guidance that we give to our founders that we invest in at the seed stage, because they know it's a much harder time to invest, to raise capital, and so it's the same thing, like a fundamentally strong business that has, leading indicators and metrics that show that it's a strong business that has the potential for growth with incremental capital. But I think, to my earlier point, in 2020 and 2021, I don't think they were listening all that well because they felt like they were going to raise money in almost every scenario. And I just think for the same reason, they were spending money on places you probably wouldn't spend on today. People are a little bit more thoughtful about every dollar that you invest into the business, right? People went from this kind of growth at all cost mentality to sustainable growth, and driving, doubling down on the places in your business that are working, but not excessively spending to get to where you need to be. It's just a different market. But founders, I think, on the whole, have been very open to this new environment. Like, it's harder to be successful, but, it's harder to raise incremental amounts of funding, but I do think at the end of the day, the businesses that do are the businesses that genuinely deserve to move on.
Yeah, I think my biggest change, is it's become more of a therapist job than it was before. I think it was a little more of a coaching job and a cheerleading job, and now I feel like it's mostly me trying to kind of help boost them up and tell them they can do it and give them encouragement, and I think that's changed a lot.
I was going to ask, you obviously had conversations with your portfolio companies when the market conditions started to change and they had to start to think about conserving cash. Are those conversations similar to what you're having now for a company that might be going out to try to raise? Take us in the room. Like, what are you telling them?
Yeah, we're absolutely telling them to be frugal. I mean, that word comes up again and again. Conserve capital, get profitable with what you have. I just got off the phone an hour ago with one of our founders, and about a year and a half ago, I was like, you've got to get profitable with what you have. And he was mad. He's like, you're the only one telling me that. I'm like, oh man, here we go. and then today he was like, yeah, it was amazing. I just couldn't hear you back then.
Right.
And now he's like, yeah. He's like, I'm looking forward to getting profitable with what we have left in the bank. Like that seems exciting to me now. My whole mindset has shifted. And so yeah, this is a constant drumbeat.
The tricky thing with it, though, is if you focus now just on getting to profitability and sort of let growth go, then you go out to raise the next round and the growth doesn't look as good. So right now, I think the hard thing for founders is that you're supposed to be profitable and really high growth and kind of have it all in a lot scrappier way.
And the best businesses are.
Yeah.
And that's what the investors are
And those
looking
are
for, is the best businesses. So if you can apply your frugality and apply all of your growth tricks and apply all of your great product design, you will have a great company, and then the numbers will prove it. And then you're just going to sit back and they'll line out the door to do your Series A. And you don't have to worry about it.
So it's much harder to be a founder now.
Yes.
It's harder to be a successful founder now, right? Like, you can start a company, you can probably maybe get some pre-seed, and if you're lucky, some seed. But really, so it's sounding like the Series A is kind of the vault that you need to hurdle, or the hurdle you need to vault, before you kind of prove yourself as a real company. Is that correct?
I think even the seed has gotten harder. I think the valuations have held steady, but the volume has dropped really dramatically over the past year. So it's still hard to raise a seed right now. I think probably Series A and Series B get even harder.
Maren, can you comment on the drop in volume of seed?
The drop in volume of seed?
Yeah,
I think it's 40-50%, the latest Carta data. For
so
Q2.
50% drop in volume.
But the valuations have stayed steady.
Okay.
It seems like that's going to be hard then when you're moving on to a Series A, correct? How do you coach them through that? I mean, that's challenging.
Well, if there's fewer seed investments, then there's fewer competitors. So one of the things that it's hard for founders to remember is that you're not competing against your competitors for money, and you're not competing against your plan for money. Like, I hit my plan, I should raise money. My competitors are doing worse than me, I should raise money. Well, they might be doing worse because your sector is bad. You're competing against all the other investments that a venture person could make. That could be a medical device, could be a robot, could be right? And so you have to be the best business that they've seen that month or that quarter, particularly for Series A. Because remember, with seed people, we would make, during the boom, we were making 8 investments per quarter. Now we're down to sort of 4 or 5. But the Series A folks might do 1 deal a year, and they might look at 600 companies, very few of which are competitive with you, but you're competing with them for that capital. So you have to keep remembering that.
Yeah, everybody's volumes are down. Every round is going to be harder than the prior round. Series A funds are doing less. Series B funds I've talked to just haven't done a deal in over a year. I mean, there's a couple factors at play here. There's the one we're talking about, which is the bar is higher. There's the other one, which we've spoken about a little bit, which is like the psychological element to what's happening in this current industry, which is there's a whole bunch of investors with egos whose portfolio isn't doing nearly as well as it's done for the last 13 years. And according to the NFX data, the vast majority of VCs started in the last 13 years. So this is their very first time that their portfolio doesn't look so good. So when your portfolio doesn't look great, you don't really want to pull out your checkbook and write another check. It's just you're psychologically not in a place where you feel like you're going to be
I think the
successful.
psychological term you're reaching for is grumpy.
Yeah.
The VCs
You're
are
in a
very
bad
grumpy
mood.
right now.
Yeah.
So this quarter, we are going to have our biggest deployment quarter ever at pre-seed. So I suddenly have been seeing a ton of good deal flow, and so maybe things are starting to turn. I don't know what you guys are seeing at seed.
We're ramping up a little bit too, which we should be the leading indicators for sort of the flow through. Like I was, catching up with some Series A and B investors last week, and they were like, "Oh, you guys are active. Okay, good. So I'll start opening my emails next year." Right? Like
Yeah.
that's how they think about it.
Yeah. That feels right. I think the way we've said it is that the punches to our founders' stomachs stopped in about June or July of this year, and we're kind of bumping along the bottom, and we're starting to see the shoots come out of exciting companies. Yeah, I think that's right.
So in the meantime, Maren, you said that you're seeing a lot of bridges, but you also referenced the Series A2, which I've seen a lot of in climate tech, particularly I think because it's really expensive to get a lot of those companies to the point where they're making some revenue. Do you expect that approach to spread throughout other sectors?
I'm seeing the, whatever you call them, bridges, extensions, 2 rounds. I'm seeing them across industries, pretty consistently across industries.
Both bridges and A2s, because A2s typically are priced, right?
Yeah, I'm using the same terminology of like
Yeah.
extension bridge or a 2 rounds.
So both priced
yeah.
and unpriced rounds.
But yeah, no, I'm seeing bridges across the board, across stages and across industries.
Yeah. I think now that we have such a breadth and depth of this startup industrial complex, there's so many investors that there's going to be a lot of ways of getting creative to keep these companies alive. I think 20 years ago, they just would have died.
Which seems positive for the entire ecosystem. Maybe a little tough in the meantime.
Could be.
Yeah.
I want to remind everyone that we will be taking questions. So we have microphones out in the audience. Feel free to get up and ask some questions here if you have them. How do you see current market conditions affecting the Series A? People are expecting a soft landing, but interest rates still remain high. What do the next 6 months to a year look like to you? It's Loren.
I mean, my suspicion and hope is that venture activity deployment picks up. But I also genuinely hope that the bar stays high. It is the right thing for these companies and for this industry to maintain a high bar and back companies that you genuinely believe can go the distance. And there aren't that many, is the honest answer. There's 30 or 21 something thousand VCs. Like, I don't know if there's 21,000 great companies every single year, right? And that's why the last 13 years happened, right? That's why there was such a bull run. Like, there was a ton of capital. So my prediction on the one hand is I think cash will start to get deployed again. VCs are sitting on funds, not called capital, but they have funds. But on the other side, right, I think there are a lot of VCs who are still going to be slow to deploy for a while because I think there's hesitation around raising a subsequent fund for especially a lot of the newer funds who perhaps over-deployed capital during the peak of 2020 and 2021 and are not looking at a fund that's in the green. Like it's gonna be a tough environment for future fundraisers that will continue for a while. But I do suspect that great companies are going to start seeing fundraising get done.
I would certainly agree with that. One other thing to note is that this is the first downturn we've gone through where the number of professional investors is so great that you have to take into account the sort of network gravity of all the new people who have flooded to be VCs who need to get their portfolio growing so that they can build their careers. So there's a lot of pressure on the older people in these venture firms that the junior people are putting on them to deploy capital so that they can build their portfolios. And so I think you're going to see a bounce back here pretty quickly because these big funds, particularly the billion-dollar ones, can't keep their younger people at bay too long.
Maren, what's your prediction?
I think if you're in this business, you tend to be an optimist. So I think we're all thinking it's going to be better in 3 or 6 months. And the founders I speak to are all saying I'm going to raise next quarter and things are going to be better. And I think we're all hoping that that's the case. But I see the same dynamics that you guys do.
Yeah, I do think that if you're a founder going through this right now, this is the best thing that could have happened to you in your career. To see frugality, to see tough times, to know what it actually takes to be a real founder. Because it was fantasy land there for about 6 years.
All right, I think we'll take a question over here.
Hey, thank you for doing this, James, Loren, and I think it's Maren, or how do I pronounce your name properly?
Maren.
Maren, thank you. First off, James, I saw you earlier at your talk, and I love your bluntness and directness. Well, this is my 7th business. It is my first tech company, so it is a very steep learning curve as a founder, especially recruiting team on equity in this environment and raising our 2nd round, which is our pre-seed. So I have a question for you as far as what you're looking for, I've learned, but as a founder, we really want to partner with great venture capitalists and with value add. So how do you recommend as a founder we bridge that conversation with you guys, and how do we appropriately ask? Because I never know quite how to put that together in a conversation, and thank you for your time.
Yeah, I think everybody up here can give you the same advice, which is number one, you want to find investors that know something about the sector you're in because they're going to give you better advice. Number two, in my opinion, is you want to find investors who have been founders because then they're going to give you the psychological advice that Maren was talking about earlier, because we all need that. When I was a CEO 4 times, I needed that a lot. I needed help prioritizing. I needed help with my own psychology. Like the greatest point of leverage of a startup is the CEO's psychology. That's it. Money, product, no. The psychology of the founder, that's it. So working on that and finding someone with whom you can work on, that's very critical. And so when I was a CEO, I would always take money from people who had been founders before, because I found that the psychotherapy that I needed was always much better. And then I would also just make sure that they're in a network that you want to be in. I tell people all the time, choose by people, right? Because you're going to be with these investors for 10 years, and they're going to introduce you to people they like. I actually had a $20 million offer from one of the top VCs years ago, and during the first 4 weeks before we closed the deal, he started introducing me to people to hire, and I didn't like any of them, and I went, oh no. And literally, he and I backed out of the deal. He and I both agreed that we would back out of the deal because I did not like his people, and it wasn't going to be a fit personality-wise. So I would key on that.
I would also say reference VCs, and VCs all have these huge promises of the platforms and all the services they're going to give you. And I find founders are often disappointed because it's not what it's marketed as. So go talk to founders in the portfolio and find out firsthand. I think that's the best way to find a good fit.
And is that a question we can ask you in our meetings and say, hey, can we talk to a couple of your founders to do some due diligence on our end?
Yeah, we proactively offer it towards the end of our process if we think we're going to get over the line and want to give you a term sheet. I say, here is every founder in our portfolio. You can call any one of them. And if they don't, I think it's perfectly okay for you to ask.
Great.
Cool.
Yeah, the off-sheet references are good.
Thank you. And lastly, most founders don't go to Harvard Business School, so I think that's funny that they're going into VC. That's great. But I also recently found out that entrepreneurship is a major now, and you can go to school and get a degree in entrepreneurship, which seems counterintuitive to how we work. So thank you for that.
All right, we'll take a question from over here.
Hi, I'm Oleg, a founder of Truly. It's like Truly, but different. So the question is, how would you describe the ideal profile of your seed round, basically? I think that it might have changed as well. We are now discussing the Series A, but what would it take to raise seed at the current conditions? the profile of the founding team, the product, the market, anything that you can share, like your ideal world from your perspective.
I mean, I can
Yeah,
take a
go ahead.
stab. You guys can fill in the blanks. I think seed is actually one of the more broad terms in terms of stages of funding right now. A lot of times pre-seed is bucketed into that. And there's a bunch of different seed funds who participate at different stages of the companies. So I can speak to where we look for businesses, and I can let the rest of the panel do the same. But I think for most seed stage funds, including Bowery Capital, we don't have any strict revenue targets. We don't have any sort of product requirements. We have invested in 2 people and an idea, and we've invested in a company that might have an MVP of the product and a couple of pilot customers. It's rarely anything beyond those 2 parameters. And we, above all other stage of funding, are investing in people. So we're spending a ton of time with the founders. We're looking for genuine passion for the space and the problem that you're solving. Like, we're not looking for the sort of, I want to start a business and I'm seeking a problem, right? We want someone who's like a domain expert in what they're building, who's ideally lived in the pain point that they want to solve because it just drove them to the point of not being able to do anything but solve this problem. We look for, grit and motivation and culture. Like, I care a lot about what kind of culture are you building. Some people are motivated by a culture that they experienced that was great. I found a lot of founders who build the best cultures were ones that worked at a company where it was horrible. And they know exactly what not to do, and that they want to build something different that people genuinely want to work at. So, there's a bunch of other checks in the box in terms of market and competition and go-to-market and actual product and functionality, but where I spend the bulk of my time is getting to know the founder.
Thank you.
And just one thing to add from me, I love to find out the founder's why. I think when you find out the motivation and what is driving them to do what they're doing, I think you can really understand them better and understand whether they're going to really push through when it gets really hard.
And all I would say is we look at 8,500 companies a year and invest in 20 to 25. So just understand the numbers and what it's going to take to compete with all the other businesses that we could potentially invest in. Yeah,
definitely. The question is if anything has changed since the last down rounds, and if you're looking for anything different.
It's the same stuff. It's always been the same.
Yeah.
All right. Thank you.
So as we're coming down on time, I have a final wrap-up question. In a sentence or 2, what advice would you give founders right now who are about to or are currently raising a Series A? Maren, we can start with you.
Spend lots and lots of time on the planning phase for the raise and do a lot of the if you have a really, really great pre-raise, then it can make the raise a lot tighter and more efficient.
I guess to add on to that, I think that running a tight process when it comes to a Series A is the most efficient way to get it done in this market. Meaning, like, in better times, in the high-flying times, people would sort of trickle conversations, catch up with VCs that are asking them to talk to them, that are at the Series A stage. And I find all of those conversations to be a waste of your time, right? And you're going to share your most exciting things, and then when you actually go to fundraise, you're going to have nothing new to tell them. Yeah. It's a disappointing conversation as a Series A investor, so don't do that. Create the FOMO, and then when you're ready, you send out 15, 20 emails to the people that you actually think are a great potential fit for your next round of funding, and run that process. Like, it's the best way to create competition. It's the best way to get people to move. People are taking longer than they've ever taken to do due diligence and make a decision. So you got to create hype, and you've got to spend time with the best investors that you have garnered relationships with.
The only quick thing I would say is don't think of the fundraising as the time when you're reaching out to VCs. Think of the fundraising as the 18 months before that.
All right. Well, still, obviously, some things in flux with Series A, but reason for optimism. So I'd like to thank Maren, James, and Loren, and they will be in the TechCrunch Plus Lounge after to do some Q&A. So thank you.
Thanks, guys.
Thank you. On this way.